Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. Thank you for joining us. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. We are a fiduciary. We're independent. We're here to craft portfolios that can do well in up markets, down markets, and sideways markets. And yes, everybody thinks you can't make money when the markets are down, but you can, and there are strategies that can do that. And I think a good investment advisory firm is going to bring those options to the table. So with that being said, I want to thank everybody for joining us this week. Last couple of weeks were best of shows. We are back, and I don't think we're going to have a repeat show for maybe the next 3 to 6 months. So we're going to really get after it here through the end of the year, and then obviously Q1, because I think a lot is going to happen in first quarter of next year. We've seen a lot of individuals that are calling for a rather large correction next year. I think it's anybody's guess, but I know that if we have a portfolio that is positioned correctly to do well in up, down, and sideways markets, then we are ready for whatever the markets throw our way. So a lot of stories to tell you this week, and on this week's show, and I'm excited to do that. So if you want to have a conversation, let's talk. 630-492-1912, 630-492-1912, and give Paige a call, and she will set some time up on our calendar. So I've met many listeners have reached out. Usually, we get probably 4 or 5 or 6 a week, and who listen to the show and have some sort of a question when it comes to their finances. And obviously, we're very, very willing and able to answer any questions that you have. Had a gentleman come into the office this week, and he said that he was nervous to come in. And I thought, well, I understand that. I think anytime you reach out to somebody you don't know, or you listen to on the radio, it can be nerve-wracking, right? Especially when you're talking about finances. And by the end of the meeting, he said he was so glad that he came in, and he was now, rather than being nervous, he was excited. And, I sat and thought after that meeting as far as why he said that, because you hear me on the radio is really how I am in person. We're very, my firm is laid back, but yet serious. We don't think that we have all the answers, yet we want to bring cutting edge strategies to investors. We think planning is important. We think income planning is important. We use the most cutting edge strategies that you can find, and cutting edge software that you can find to manage risk. And so I started to think a lot about that. And I wanted to make sure today that I reached out and made, a statement on just kind of that topic. Don't let nervousness or do I have enough money? I don't know you. Should I reach out to you? Should I not reach out to you? Don't let that hold you back. And I mean, yes, it sounds like a very self-serving topic or a self-serving message because we want you to call in. But the bottom line is we're here to educate. We're here to be your financial quarterback. And another gentleman that we met with from Central Illinois, we were going over all of the strategies, and he was with another firm, a firm that we tend to take a lot of business from, just simply because of their buy and hold nature and their lack of diversification, which really is 9 out of 10 advisors, even though you just don't know it, but that is the case. And, through our conversation, I met him twice, and we actually met outside of the office. Again, we don't care if we meet over Zoom, if you meet in our office, we meet at your home, or if we meet anywhere, really. I mean, I'll educate anybody anywhere, and that's my job. But, having that conversation with him, And we were going over the strategies because if you've listened to the show, you know that I think the two most overlooked area of financial planning are tax benefits and tax strategies, and then protection strategies. And it's hard for people to understand, individuals who don't live and breathe this business, because everybody is in an industry, and something that may seem very basic to you, it could be very complicated to me. And it's no different when it comes to the investing world. What we do is absolutely unique. It's absolutely cutting edge, but you could do it. I mean, it just takes some time to truly understand it. And I have a 26-year head start on you, but that doesn't mean that you can't do it. I mean, it's not rocket science. I mean, it is an art and a science. But anyways, so he had two accounts, and he had 80% of his money at one firm, 20% of his money at the other firm, and we were going through. We talk a lot about the dual directional notes on the show. And if you've listened, you know that those are relatively short term in nature, 15 months. And you get a cap on the upside of the S&P, which could be 15%, could be 23%. It just depends on where the market is. It's issued by a bank, JP Morgan, Morgan Stanley, UBS. All of the big banks offer them. And when we meet with somebody who's with those banks, they'll immediately say, well, why didn't they tell me about it? And it's, I don't know. I just don't know. I wish I did. But anyways, so it's backed by a bank. You have an upside capture, which is generally very good. Most people are content with, the gains that you can get over a 15-month period. But what starts to get people, and it almost sounds too good to be true, is the fact that you can make money if the markets are down. And we'll use either the 15% or 20% absolute return level. And all that means is if the S&P is down that much, then your return is positive. So in 15 months, if the S&P is down 15, well, you're positive 15. If it's down 20, you're positive 20. And people don't fully grasp or understand the fact of how is it done. We have to get out of this. It's too good to be true. These instruments are a debt security, a bond offered by the biggest banks. And if the biggest banks default, well, then they're going to default on all of their bond holdings. And it's just not happening. So anyways, we were talking about the dual directional notes and how adding those would be a very timely, especially going into next year, probably a timely investment. And then we started talking about fixed income, and he had 35% of his money in fixed income, and it was down 18%. Plus or minus, but and he just didn't understand why. And so, he looked at last year, and his equities and bonds, which are supposed to be safe, were down. And so we started talking about, bond replacement strategies that can give you, very similar protection on the downside, but without any interest rate risk. And then we're talking about equities, and he happened to have mutual funds. And if you've listened to the show, our belief in mutual funds is they're not transparent. They're not tax efficient. They're not customizable. We think they're a very lazy way to invest, especially if you're working with an advisor and then they're charging a fee on top of the mutual fund fees. And so we were talking about all this, and we were talking about our tax strategy, and we're going to get to that, here momentarily, because I want to make sure everybody hears that. And I could tell that it was just a lot of information. And I think my job, or a job of any advisor, is to bring strategies that are going to be new to you. Because if they're new to you, if you can fully understand your strategy, you probably have nothing more than a closet index fund, a fund or a portfolio that's going to go up with the market and down with the market. And that's just not good enough, especially in this market and what we may be coming into. One of the strategists at a big bank said, the markets could drop 25% next year. And I had a bunch of clients ask that, what do you think about that? Because it was a very well-known name. And the answer was, who knows? Nobody knows. Nobody knows what's going to happen. But what I do know is that we have strategies that will profit if the markets do that. Most investors can't say that. And I am very happy to say that ultimately we can. And so I was talking with this gentleman, and I said, listen, you know what? Here's what you need. you need a quarterback of your team. You're the general manager. You're the CEO of your team. I don't know if it's your baseball team, football team, soccer team, whatever your favorite sport is. And you need, in this instance, it was football. And I said, you need a quarterback. You need a quarterback who lives and who breathes this information, who can vet this information in a way that you can't, who can basically take the whole world of finance and all of these strategies that may seem super complex to you. They may seem too good to be true to you. And you can have a quarterback that can craft a portfolio that can really do well when the markets go up. Obviously, most people can do that, but also can do well when the markets don't go up. And that, to me, is critical, especially in this market. Wall Street has not done a good enough job of explaining just how detrimental portfolio losses are. And I see too many advisors, just way too many advisors that have portfolios that I know for a fact that they wouldn't invest that way themselves. And so it is a very self-serving industry. It is a very self-serving business. Wall Street wants you to think that you can't play defense, yet they hedge and they speculate and they take advantage of volatility with their firm's money every single second of every single day. But when it comes to a large fee, it's simply the fee revenue. They want that fee revenue. They want that fee revenue from their clients. They want their clients to think that they can't play defense, that there are no strategies available to be able to make money when the markets go down, or at least limit losses when the markets go down, because they want that fee revenue. Look at it. Just read their earnings, and everything is ARR, annual recurring revenue. And it's the same thing with advisors. Advisors simply stopped managing risk. They've done what is easy, which is, diversify a portfolio between stocks and bonds. And a client thinks that they have a well-diversified portfolio because they have, 15 or 20 or 30 different investments, yet they own two things, stocks and bonds. And they wonder why, or equities and bonds rather. And they wonder why in a year like 2022, the markets go down, their safe money also goes down with it. So when we see credit card defaults that are rising at a faster pace than the peak of the financial crisis, there's just a lot of things that make you go, what is going to happen? And if anybody can tell you they can predict the market, they're probably not being honest with you. But again, we don't waste any time on trying to tell you where the market's going, because we don't know. Nobody knows. But what we do waste a lot, well, I wouldn't consider it a waste, but what we do spend a lot of our time on is talking about, again, markets can go up, they can go down, and they can go sideways. Let's talk about strategies that'll do well when the markets go down. Let's talk about strategies that'll do well when the markets are sideways. And then the up markets, they simply take care of themselves. So I want to challenge every listener. If you're listening, today, driving around in your car, if you're catching the show on podcast, I really just want to make sure that ask yourself, if the markets drop 25 to 30% next year, which many people think that it could happen, and it could be a high probability, what does that mean for your portfolio? Do you have hedges? Do you have investments in place that can actually take advantage of that volatility? Not only take advantage of that volatility, but actually make money when the markets go down. Again, credit card, delinquencies are rising at a faster pace than the financial crisis. Think about that. Unrealized losses at U.S. banks now represent 30% of their equity capital. I mean, this isn't me making up, this isn't me saying these statistics are, well, I think. I mean, these are just what the statistics are. And you have to realize in this business, advisors are paid to always be bullish, never to think the markets are going to go down. And it's unfortunate. And the person that gets hurt are you. So if you're 5 to 10 years from retirement, if you're in retirement and you're not convinced, you're not 100% certain that if the markets drop 20 to 25%, that you don't have a bucket of your money that you know for a fact can actually protect principal or even potentially make money in the down market, then we just need to have a conversation. And again, my job is to convey who I am on the radio, so you are not nervous, intimidated. Do I have enough money? Do I not have enough money to reach out? Just reach out. I mean, that's it. That's all we're going to do is help educate you and then let you decide ultimately what's best for you and your family. So when we come back, we're going to talk about taxes and we're going to talk about alternative assets. And we're really excited about a strategy that we're rolling out. So give Paige a call, 630-492-1912, 492-1912 and set some time up for us to have a conversation this week. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're a fiduciary. We're independent. We're a registered investment advisory firm. If you want to have a portfolio that can do well whether the markets are up, down, or sideways, then have a conversation with us, because if the markets drop 20% and you're not convinced that you have a strategy in place that can protect that principal or even make money when the markets are down like that, then we need to have a conversation, because strategies like that exist. And our job is ultimately to make sure that at least you know about what it is and what it's not. And then you make the decision if it's right for you. I'm tired of lazy advisors. I'm tired of clients having portfolios that simply track the market up and down. And that's just not good enough. It shouldn't be good enough for you, and it's certainly not good enough for us. And that's just an issue, because people who think that the market can't stay down long, it can. If you bought Microsoft in 2000, it took you 14 years to get back to even. Think about that. How would that affect you today if you're retired, or if you're 5 to 10 years from retirement? What happens if we're in a down market where you see negative returns? We go up, we go down, we go up, we go down, but yet we go sideways and really don't go anywhere. What does that do to your plan? Because the best laid out plans need gains, because most advisors are still using old, antiquated ways to calculate retirement income, and they're still providing a probability analysis of an individual's success rate in retirement. And what they don't understand is there are outliers, and outliers happen more than you would like to know. And I think that's only going to continue to happen with this market and how computer driven it is. So this segment, I want to talk about two things, and I'm sure I'll go sideways and down many rabbit holes, but there's two things I want to get to this segment. First is tax planning, and second, I want to talk about the markets and computers and what they're doing to individual equities, and kind of, you can either be controlled by them or you can actually take advantage of them. And I'm going to give you a story about how to take advantage of those opportunities. So let's talk about tax planning. Tax planning is a year-round activity. It's if you've listened to the show, you know that if you're with a big bank or a big brokerage firm, you are getting no proactive tax planning. The most that you're getting is trying to match losses with gains to minimize your tax due, and that's not tax planning. I mean, that is like kindergarten when it comes to investing. But unfortunately, if you're with a big bank or a big brokerage firm, that's the best they have, and that it shouldn't be good enough for you, and it certainly isn't good enough for us. And every single higher net worth client, and we look at high wage earners, couple, $300,000 or more, or net worths of $1 million or more, you have access to strategies that you need to take advantage of if you want to reduce your taxable income. And the strategies that we are, we have a couple weeks left this year to affect what your tax bill is going to be, and we have a strategy in place that we think is significant. We think it's very, very unique. We think we are providing access to something that individuals for $100,000 to $1 million investment have never had access to invest before. A lot of it is due to the banks in the energy space, the banks limiting leverage for the big energy companies, making them live more within cash flow. And for the first time, if you have access to deal flow, and if you have access to the opportunities, because that's it doesn't matter how much you have. You could have 50 million. And if you don't have access to the deal flow, all of your money is just doesn't mean a whole lot. We do have access to that. We do have a fund that has access to that. Our strategic advisors in the energy space can see deals that are being, for really the first time for individuals, smaller funds to participate in. And so what you look at and what you receive first and foremost are significant tax benefits to the tune of up to 80% of your initial investment as a income offset. So simple math, put in 100,000, you're going to be able to write or use that to reduce your taxable income this year by $80,000. Put in $1 million, you can reduce your taxable income by $800,000. And so the tax benefits are significant. And especially here in the Midwest, it's just an asset class, a segment of the market that if you look at energy and if, a couple ways to invest in energy, well, you can buy the bonds of the company or you can buy the underlying common equity. Unfortunately, you don't get a tax benefit for either of those two. Or for the first time, if you have a fund that has access to these deals with the majors, we're talking but not limited to Exxon, Chevron, Occidental Petroleum. I mean, there's just all of the big guys. You can now invest alongside them at the asset level, and for that you get significant tax benefits. And so if you sold a building, sold a business, if you're a high wage earner, we can reduce your taxable income significantly. And very strong, low double digit targeted distributions annually. So is it, are we hitting home runs or grand slams? No. Singles and doubles and triples. I mean, I think if you get the tax benefits and you can get, single to mid double digit annual distributions, I think most people should be content with that. And relatively, if you look at kind of, the investment time horizon, it's relatively not long, given the fact that we're going to offer and we have offered conditional liquidity. And so we're telling individuals, to target, or, we're targeting at least, somewhere in the neighborhood of an IRR or, return on your investment of anywhere from 1.4 to 1.6. So huge tax benefits, good distributions, and, I would say a fair rate of return on your money. And if we look at where the market's going, that could be your saving grace next year if the markets drop, because this strategy isn't directly affected by the equity markets or the fixed income markets. And so this is a strategy that we are really going to spend a lot of time talking about, because we're trying to provide institutional access on the tax side, on the alternative diversification side to individuals. And so with that being said, again, if you sold a building, sold a business, high wage earner, have a net worth of $1 million or more, you qualify for this opportunity. And we certainly want to dive deeper into it. So give us a call, 630-492-1912, 630-492-1912. And we'll talk about it, because you have a couple weeks this year to make a great impact on this year's taxes and what your tax bill is going to be. But it'll be there as well next year. So it's, but we're certainly wanting to share, I can't tell you how many of our clients have said, the tax benefits are just fantastic. And again, it kind of comes back to that. Is it too good to be true? I mean, we're not tax advisors, so I don't want to hold ourselves out as that. This is very basic, tax information and when it comes to certainly the strategy, but we always say check with your tax attorney, check with your tax advisor, make sure that you reach out to them. But again, this isn't cutting edge, crazy tax stuff. When you invest in energy in the right space, you get significant tax benefits. And so when we look at, one of the top 2 oil reservoirs in the world, and we can partner with names that the industry giants for the first time for individuals, it's probably something that it makes some sense for you to hear. So 630-492-1912. 1912, 630-492-1912. We talk a lot about inflation, and, obviously the Home Alone movie runs nonstop, this time of year, right? And great movie. We watch it multiple times, with the kids, with the family, and it's just fun to watch. And I saw a post of what the main character in Kevin, what his grocery list cost when Home Alone was done. And his grocery list was $19.83. Think about that, $19.83. Today, just last year, that grocery list, same items, $44.40. So $44.40, okay? This year, and that was just last year. This year, a whopping $72.28. So think about that. I mean, the grocery list in Home Alone, $19.83. Last year, that same grocery list, $44.40. This year, it's a whopping $72.28. That is inflation. That is why, we are so worried about inflation. That is why when you look at, when you have a fixed income, when you retire, where you have a finite amount of assets, and we're living, obviously much longer, 15, 20, 30 years in retirement without a paycheck. And you're looking at, just from last year, 60, 70, 80% increase from what groceries were last year. It's an issue. Since 2020, again, U.S. groceries are up 25%. Used cars climbed 35%. Rents roughly 20%. Surveys have showed a four-person household spent an average of $238.32 a week in food. A similar survey in 2023 showed that figure jumped 32% to $315.22%. So that's an issue. So you have to think, and that's why I think Wall Street has failed individuals. Most advisors, they don't even use software for their clients to know what has to happen where they can get a pay raise, or what has to happen if they need to take less money in a year. Those are not fun conversations, but running out of money is a lot worse. And, I see a lot of people again, working with us isn't based on a dollar value. We help people with 100,000. We have clients that have 30, 40, $50 million net worths. Working with us really is, twofold. Number one, can we help you? And number two, are you receptive to that help? So I see, generally the clients who have under $1 million, they're really worried about income and future income, and they're really worried about inflation. And, we can all say, inflation is what it is, and it just means my dollar is going to be less, worth less tomorrow. But when we bring it home and we look at 32% increase just from 2020 to 2023, I mean, that's a big deal. Are your investments keeping up with that? Is your standard of living going to go down? How are you going to ultimately fix that? So, again, we're concerned. The $1 million to $5 million client, they're not necessarily worried about paying their bills, but they're not maximizing their income. They're allocating far too much capital for far too little income. And it's unfortunate because, advisors are still using the stale data, the stale strategies that they used 10, 15, 20 years ago. And think about it. You're not using those same cell phones. We're not driving those same cars. And it's the same with risk management. The strategies that the big banks, the big insurance companies, the big institutions are now able to roll out because it's become more profitable to them, where before you needed $1 million, $2 million, $3 million to take advantage of it. Now we can do a lot of these strategies for $1,000. So again, give us a call, 630-492-1912, 630-492-1912. I did not talk about stock trading and equity management, but we're going to talk about that right after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and we are fiduciary. Everything that we do is to craft a portfolio that can do well whether the markets are up, down, or sideways. That's our mandate. That is the mandate. It should be the mandate for any investment advisor. When people call us and talk to us, we spend more time talking about the strategies that we have in place that you can actually make money when the markets go down, or strategies in place that can protect your principal when the markets go down. That is the focus of our firm. When the markets are sideways, we want to talk about trading strategies, again, that can do well in a sideways market. Because, again, really simplistic. Markets go up, they go down, they go sideways. Our focus is protection, growth, opportunistic growth, and then tax strategies. I mean, it is literally that simple. Complex strategies, without a doubt. But again, like I tell people, not making a change is hard for anybody. Now, we do it every day for clients, but change is hard, right? And I get it. For us, it's second nature because this is what we do. We want to help. We want to be passionate about helping and making sure that if you're paying us to manage your money, that we're bringing something to the table, that we're not just, when the markets go down, saying, oh, well, it's going to come back, right? Well, okay, if you bought Microsoft in 2020, it took you 14 years to come back. So is it going to come back? Sure. When is it going to come back? Who knows? My question would be, well, then why am I hiring you? Well, we can point to strategies that, listen, the markets are down 15. Well, the strategy was up 15. Those strategies exist, and they're relatively basic. Our job is to take the complex, to be your quarterback, and craft a portfolio that can do well, again, when the markets are up, down, or sideways. So give Paige a call. She'll set some time up for us to have a conversation. 630-492-1912, 630-492-1912. And, let's just talk, and let's just see, because, again, who knows what's going to happen in the markets? I mean, I just don't know. Nobody knows. And unfortunately, 9 out of 10 advisors are always going to tell you it's going to be up. It's going to be up. It's going to be up. Everybody comes on TV. It's up, 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 never going down. Well, that's a very self-serving statement, because their clients only make money when the markets go up, and when the markets go down, they don't want you moving your money, so they lose fee revenue. And we're going to just bring it home in 2024 on what advisors are doing wrong for their clients, because I'm just tired of it. I'm tired of clients simply being on the roller coaster because somebody has a fancy degree or they have work at a fancy firm. It's irrelevant. Okay. When it comes to investing, show me on my portfolio right now, Mr. or Mrs. Advisor, what do I have that if the markets are down, that I'll actually make money? And if you don't have that, then we have to talk, because these are really basic strategies, high level, complex, offered by the best banks and insurance companies in the world. But it's something that we have lived and breathed ever since I got in this industry and the financial advice business in 1996, 1997. It's now becoming maybe, cooler, I guess, to talk about these strategies, but 9 out of 10 don't. And you're paying most advisors to do nothing more than track the market up and track the market down. And that's just not good enough for us, and it certainly shouldn't be good enough for you. So, okay, let's get to equity markets. Very interesting time. So again, everything we do is about positioning an investment. And I hear often, what do you think about this investment? What do you think about that investment? What do you think about annuities? What do you think about hedge funds? What do you think about options? What do you think about anything? And my answer to everybody is, it could be the best investment you ever make, or it could be the worst investment you ever make. We have to know what is the purpose of the money. And if you meet with us, everything you're going to see is up, down, and sideways, because the markets can only go 3 ways, up, down, and sideways. And when we talk about a portfolio and we talk about construction, it's protection, it's growth, it's opportunistic growth, and then it's tax strategies. And that's kind of our pyramid. And when we, so for right now, I want to talk about growth, and I want to talk about opportunistic growth. And unfortunately, individual investors, the way that many make decisions is they look at what did well last year or what did well the last 3 years. that has there's zero relevance of what did do well to what's going to do well. Look at small caps, for example. Small caps have had a terrible year. Had a lot of clients that wanted to get out of small caps this year. Well, guess what? The small caps are coming back as interest rates are coming down. We had a top strategist on the street that, we listen to, and he's on CNBC all the time. He thinks small caps could jump 50%, but it's very hard for an individual to put something in an asset class that's not doing well. Advisors are the absolute worst because it's hard for them to articulate to their client, why are we allocating to an asset class that hasn't done well? Again, rear view mirror investing, unfortunately, advisors do it the most. Individuals do it the second most. What did well doesn't mean it's going to do well. And so, you look at small caps. Rather than reducing the allocation, what's the risk reward? What's going on in interest rates? Maybe we need to reallocate. Maybe we need to double our allocation to small caps, increase it at some level. And, we have, strategists again coming out and saying they could jump 50% in a year or two. So, but when it comes to equities, right, there's something going on in the market, and it's very, very strange. We are seeing names in targeted asset classes go up 5 to 10% and then back down 5 to 10%, up 5 to 10%, then back down 5 to 10%. Something's going on, and it's very strange. And I think that we're going to find out at some point that the markets are being manipulated they're just being manipulated somehow, some way. And I think with computer trading, I think you look at the big hedge funds, you look at the big institutional money, they can push names around and they trade. Individuals are really the only buy and holders out there. Buy and hold is just an absolute joke. And we can debate that. And I would love to debate that at any point that you want. Again, buy and hold forever is a joke. There are times to buy and hold. Then there are times to be active management. Do you think firms, do you think hedge funds, do you think the smartest money in the world just buys an S&P fund and never trades it? No way. Absolutely not. So then why is that advice pushed to you? It's because, again, they want that fee revenue. They want that fee revenue. They want their advisors out there trying to find new clients, not managing money, not managing risk. And it's unfortunate. But again, everything does come back, but it could take a long time. Just look at the early 2000s to 2010. Look at what the markets did during that period. They didn't do anything. Bought Microsoft in 2000, took you 14 years to get back to even. Now, yes, I am cherry picking that date somewhat because we immediately had 2001 and 2 were down, of course, and then they ran, and then 08, was down again, and then it ran. But look at where we're at in the market today. There's a very high likelihood that that could be an issue. And so our job as advisors is to allow clients to try to take advantage of that. And to know when to buy, know when to sell is very challenging unless you have math behind you. And one of our partners, and not partners in that we own them or they own us, but one of our, let's call it a strategic partner who we allocate a lot of money to, they have recognized that $6 billion shop, so it's meaningful and purely mathematics, algorithms, and their algorithm worked for decades. And this year it was challenging. And what they found was just as soon as you made money, the markets ultimately gave it all back. And then that would mean you'd go to, put some risk or protection on, then the markets would run. That happens. You have a good advisor and you have a good firm that brings to you opportunities that whatever the markets are doing today, that we're bringing opportunities that can do well in today's market. And this manager that we use, you can't get to them direct. Well, you could. They have 2 ETFs, but if you want their managed accounts, you can't get to them direct unless you have significant means. But again, for us, it's $100,000. And what we're doing is they've created a strategy to take advantage of those movements, fluctations in the market. Again, not trying to time it, not trying to get in at the bottom, out at the top. But if we're in a very defined channel, a very defined pattern with the biggest companies in the world, the computers can see that. and you can either be controlled by it or you can take advantage of it. So again, when we look at growth, those are the things that we're bringing to the table to kind of complement, our other strategies. So 630-492-1912, 630-492-1912. We're going to go over 8 investment ideas to help you after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want to find outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. 630-492-1912, 630-492-1912. Give us a call. If you're not 100% convinced that your portfolios can handle a down market or sideways market, ultimately we need to talk, because there are strategies exist that we need to bring to the table. Strategies that you can make money when the markets are down. Think about that. Make money when the markets are down. These strategies are offered by the biggest banks in the world. So this isn't some fly-by-night strategy. I mean, we've been using a lot of JP Morgan dual directional notes, Morgan Stanley dual directional notes. Handful of years ago, 10 years ago, 15 years ago, I think the minimum investment in these strategies was $1 million. They're just not mass marketed today. It's $1,000 actually, $1,000. So again, our job is to make sure that if the markets are down, you have strategies that can protect principal, or strategies that can actually make money if the markets are up. Certainly, we want to take advantage of that as well. And then if the markets are sideways, we have to have strategies. We call it the opportunistic growth strategies, but strategies that can take advantage of trading. Seriously, trading. That's what Wall Street does. Yet when it comes to individuals and it comes to advisors, they don't know how to trade, because it's really simple. For advisors especially, they want to grow their revenue. They want to grow their fee revenue. They don't want to be staring at a screen all day. They want to be out finding new clients, because if they're managing 100 billion, well, they want to manage 200 million, because you can do the math. If you're making 1% on that, I want to go make 1% on 200 million, 300 million, 500 million, et cetera. So risk management today is really just not there. And you don't know that because this isn't something that you do every single day. I know it because I live and breathe risk management. So I'm able to look at a portfolio, immediately tell you if you have a strategy in place that can do well when the markets are up, down, or sideways. And 9 out of 10 that we talk with, that they just don't have it. So again, our job isn't to tell you to make changes. Our job isn't to tell you that what you're doing is wrong. Our job is to tell you what you have, what will happen if the markets go down, or trade sideways. How would that affect your portfolio? And let you make the decision. So, we've talked a lot today about a lot, and that's, I talk a little faster. I think it's just my passion coming through, because I'm just so tired of bad investment advice. I'm tired of lazy advisors who are making $300, $700 million, $2 million a year, and they're bringing nothing to their clients. And, in years like last year, they added no value. This year, I can't tell you how many people I've met with that have underperformed the market drastically this year. And when we have strategists that are coming out and saying we could see a 20 to 25% correction next year, we're going into an election year. Who knows what's going to happen? Again, we don't know. But I do know that if we have strategies in place that can mitigate the downside or even make money when the markets are down, that could help you mitigate your portfolio losses if the equity markets go down. So that's what we're doing. The best way to give you kind of an idea of how people work with us, I'd say 70%, maybe 80% of the clients, we handle 100% of their money. That's not all eggs in one basket. As we talked about earlier today, that's one quarterback. That's one advisor that you trust that can look at all of these different strategies, filter out the junk in the ones that are good, and then craft a portfolio of many different things that can do well. Again, when the markets are up, down, or sideways, that's not putting all your eggs in one basket. I mean, that we may have 7 or 8 different baskets. You just have one quarterback that you trust. And then I'd say, 15 to 20%, we're a satellite manager. meaning they may have, something less than 100% with another manager, or they're doing it on their own. Like I tell people, this is not my, this isn't what's best for me and what's best for my firm. It's not my agenda. It's your agenda. My job is, especially in the 401k space, I can't tell you the level of expertise and sophistication that we can bring to your 401k. Most people, if you're with Fidelity, if you're with Charles Schwab, if you're with Empower, so if your 401ks are at Fidelity, Schwab, or Empower, and some other ones, but those are generally the big ones, you can have third-party money management. And here's the best thing. It doesn't cost you any more money than what you're already paying today. When I look at the 401k space, and a lot of times it's the largest asset that people have, there's just no management in there. There's no risk management inside of there. And so you're riding this roller coaster up, you're ring the roller coaster down, and that can be a challenge at the wrong time. If you have losses at the wrong time, it can be catastrophic. And again, it's just unfortunate, but we're going to get proactive about it. We're going to get, much louder, and we're going to try to get the message out in 2024 in a way that we haven't, because we know that if we educate, if we articulate to people who, generally people who reach out to us, they're not convinced that if the markets go down, they won't lose money. And that's my ask. My ask to you is, because in the up markets, everybody does well. I mean, if I could outperform your current portfolio by 5%, 10%, yeah, that's great outperformance, no doubt about it. But is it going to change your lifestyle? Most people are going to say no, right? But it could change your lifestyle if the markets drop 20 to 30 to 40%. And you don't have anything in place that can mitigate or make money when those markets are down. So we ask people to reach out to us. It's a very simple question. Ask your advisor, ask yourself if you're managing the money on your own, or just look at what happened last year, because a lot of times advisors can dance around things and make you feel wrong for being right? I mean, it's just the way the industry is. But if you don't have something in place that if the markets drop 20 to 30% and you can protect that principal or even make money, then you owe it to yourself to have a conversation. And that's all we're having. So we're looking forward to, finishing this year strong. Again, you have a couple weeks left to greatly reduce your taxable income, especially here in the Midwest. Energy strategies are just, they're not as prevalent as they should be. It's really lack of education from advisors. If you're with the big bank, if you're with a big brokerage firm, you're not getting access to strategies that can reduce your taxable income by up to 80% of what you invest. So you invest $100,000, reduce your taxable income by up to $80,000. Invest $1 million, reduce your taxable income by $800,000. Again, very basic tax concepts, but again, we're not tax advisors, we're financial advisors. So we always recommend talk with a tax accountant, talk with a tax attorney. If you don't have one, we have plenty that we can refer out to you. But here in the Midwest, people just don't take advantage of energy strategies. Our office, we had an office, we still have a very heavy presence in the Texas market. Again, if you can hear the show, we can work with you because we run in multiple markets. But here in the Midwest, they're just not there. And I think it's because advisors just don't know any better. And again, the job of an advisor is to vet strategies that can, we're big cash flow investors. So if we can reduce your taxable income greatly, I talk with a lot of people who sell businesses or sell 2 flats or 4 flats or 6 flats or, sell anything and they have a big capital gain and they just don't have any way to reduce those capital gains and high wage earners. I mean, generally if you make, north of $300,000 a year, the qualifications are not my qualifications. They're the SEC's qualifications. You have to be accredited. Accredited means, which I think is, in my personal opinion, it's a joke because I think everybody should have access to good strategies, but they set the accreditation at $1 million net worth exclusive or not inclusive, excluding your home. So $1 million, not including your primary residence, or the income I think is $300,000 to $400,000 now. And that makes you accredited. What does that mean? That means you can have access to these strategies. And there's just very few advisors that talk about tax management and we're not talking about municipal bonds. We're not talking, which are all good, very, very good. We're not talking about matching gains with losses and trying to mitigate taxes that way. All very good things. things. We're talking about ways to greatly reduce your taxable income. Again, and still have strategies that can are built for and targeted for, low to mid double-digit annual distributions. I mean, that is what investing is. You can invest in, if you look at a pension fund, or if you look at an endowment, for example, many endowments, at least the big ones, have 30 to 60% of their money that's not tied to the equity markets or the stock market or the bond market. It's the private markets. It's the energy strategies. It's private credit. I mean, there are just so many different strategies out there. But again, it's hard for most advisors. Most advisors don't want to take the time to learn something new. And then when you explain you show something new to a client, it takes that client a week, a month, a year, whatever that is, to finally understand something new. That's okay with us, because my job isn't to do what's easy and get you as a client. And then when the markets go down 15 to 20% and you call me and say, I have nothing in my portfolio that mitigated that downside, why am I working with you? Those are the things that we don't want to have conversations with clients about. We want to have conversations that, again, when the markets are up, we want to talk about our strategies for growth, our strategies for opportunistic growth, our strategies for sideways markets, which can utilize computers. Again, I didn't write it, but I give you access to those experts that did, because you can't get to them if you're not working with somebody like me who has access to these advisors. Not only has access, but is vetted and is used for multiple years, so I know what to expect. And then when it comes to the protection side, again, I mean, whether you want to protect all your money and get 10% of the S&P, that exists today. You could have 100% principal as of today. Actually, you could have 100% principal protection and get the first 14% of the S&P 500, and the gain is locked in each year. Again, doesn't mean that there's pros and cons. There's things that you have to know, but that investment exists. So who am I to say that shouldn't be for you or not for you? My job is to say, here's what it is, here's what it's not, but that exists today. You can get 100% principal protection, and as of today, the first 14% of the S&P 500. And now that investment doesn't include dividends, but you get the first 14% of total return, or the price movement of the S&P. For some people, that sleep at night factor is huge, and you probably didn't even know that exists. So our job as advisors is to take all of these complex topics, all of these complex strategies that are offered by the banks, that are offered by the insurance companies, and bring them to you and talk about the good, the bad, and the ugly, because it doesn't matter, again, what an investment is called. I could care less. Annuity, hedge fund, options, shorting. I mean, it just doesn't matter. It just doesn't, beta and these volatility controlled strategies. None of that means anything to me, because there's a pro and a con. And when we can construct a portfolio that has, more pros, and you can live within the requirements of a strategy, because there's always a requirement of strategies. I mean, even if it's, CDs, you have to hold them for a period of time. That is just a requirement. Are CDs keeping up with inflation? And after taxes, are you really keeping up with inflation? I don't think so. Now you have that principal protection, but are you really growing your money? Well, we talked about inflation earlier in the show. So these are the things that you need to find a quarterback. You need to find a quarterback that's always on the cutting edge of what is out there for individuals, because it's our job to take this complex and be your shield. Keep the junk out, and then bring you ideas that we deem as appropriate, and then let you decide whether they're good for you or not good for you. So give Paige a call this week, 630-492-1912, 630-492-1912. I know, it's the end of the year. Christmas holidays are here. We're still working. So we, our job is to educate. We'll educate anybody who has a desire to learn. So 630-492-1912. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.